talk about vendor take-back mortgages. In Canada, a vendor take-back mortgage is also known as seller financing or a seller take-back mortgage, and it's a type of mortgage arrangement where the property seller provides financing to the buyer for just a portion of the purchase price. This means instead of the buyer obtaining traditional mortgage loan from a bank or other financial institution, they'll receive part of the financing directly from the seller. Here's how a vendor take-back mortgage typically works. It all starts with a purchase agreement. The buyer and seller agree on the terms of the sale, including the purchase price, down payment, and other relevant details. You'll then need to have a seller financing agreement. As part of the negotiation, the seller agrees to lend the buyer a certain percentage of the purchase price. This amount becomes the vendor take-back mortgage. For example, if the purchase price is $800,000 and the buyer can only secure a $600,000 mortgage from a traditional lender, then the seller might agree to provide a vendor take-back mortgage for the remaining $200,000. You'll need to set the terms and conditions. The terms of the vendor take-back mortgage are negotiated between the buyer and the seller. This indicates the interest rate, the repayment schedule, and any other conditions that you have. There needs to be legal documentation. Just like traditional mortgages, the vendor take-back mortgage is documented legally to ensure that both parties understand their rights and obligations. This documentation should be overseen by a lawyer with experience with these types of mortgages. The vendor take-back mortgage is registered on the property's title, indicating the seller's interest in the property as a lender. This helps protect the seller's financial interests in the case that the buyer defaults on the mortgage payments. So how about repayment? The buyer makes the regular mortgage payments to the seller according to the agreed upon terms. These payments cover both the principal amount borrowed and the interest. There can be benefits to both sides. For the buyer, the vendor take-back mortgage can be an alternative when they might not qualify for a traditional mortgage due to maybe some credit issues or for any other reasons. For the seller, it provides an opportunity to sell the property faster, potentially at a higher price, and earn some interest income on the mortgage loan. However, there are risks for the seller, such as the buyer defaulting on the mortgage payments. In such cases, the seller may need to initiate foreclosure proceedings to retain possession of the property. It's important for both the buyer and the seller to conduct thorough due diligence, consult with legal professionals, and ensure they fully understand the terms and implications of a vendor take-back mortgage before you enter into any of these types of agreements. Keep in mind that regulations and practices may vary by province in Canada, so it's advisable to seek legal advice from professionals. If you're looking for help navigating this type of process, well, you better call Paul.